All right, everybody, welcome to the Underwriting Fundamentals Workshop. I am David Monroe, CCIM, your host, your instructor, your mentor, your coach, your whatever you want me to be. I am a little sick, so this is going to seem very underwhelming. I apologize for that, but we have to get through this because of time restrictions, and I just have to push through it. So that's what we're going to do. So forgive me for how low my voice is. My throat's swollen up. I can barely talk, but we'll get through it. So what are we going to do? Well, the agenda for the course, we have 3 sessions: this Saturday, next Saturday, and the following Saturday. Each lesson will start at 10 a.m. Central Time, 11 a.m. East. And today's session is going to be about defining the APOD. We're actually going to go a little deeper than just defining the APOD. Session 2 next Saturday will be the 6 fundamental assumptions, how to find them. So we're actually going to go grab them from different resources and how to interpret them. And then we're going to take those assumptions in session 3 and we're going to put them into a model and we're going to underwrite a deal. Okay. So that's what this workshop is going to be about. And so for today, we're going to talk about definitions and acronyms. So we did a little bit about that in the masterclass that you guys were on last Tuesday, but we're going to take a deeper dive into the definitions and acronyms, and there are a lot more. I only gave you a small subset of them. We're going to talk about key performance indicators, otherwise known as KPIs, and different fees and costs associated with doing a deal. So we have costs and then we have fees we could receive. We'll cover both of those. So that's going to cover today's session. So let's get rolling. Definitions and acronyms. We're first going to go into what do we need in order to start to make a decision on our initial underwriting. So this first section of definitions and acronyms, we'll talk about the needs, and then from there, we'll get into the APOD, and then we'll get into the KPIs, and then the fees and costs. So for needs, the first thing we're going to start off with is, obviously, if it's on market, there's going to be more than likely an offering memorandum, especially if it's a larger property. If it's a smaller asset and it's maybe a boutique broker or even a residential broker, you're probably not going to have a offering memorandum associated with it. It's okay. We don't need one. All right. The bigger brokerages do it to try to sell you on their pie in the sky numbers. We're not going to go for those pie in the sky numbers anyway. But an offering memorandum is a document created by a broker designed to give you the information necessary to make an offer on an investment grade asset. So let's look at an offering memorandum. So here's one that IPA, which is Marcus and Millichap, out of Texas. The Presidio, this was an offering, I don't know, 6 months ago or so, on a deal in, is it Allen, Texas, I believe? So the offering memorandum we could see is 48 pages. Let me increase the size of this so you guys could see it a little better. So there are sections. Well, we got to decrease the size actually a little bit because that's too big. There we go. Oh, they got one of these. There's certain information in here that we want to take a look at because we need, and there's a lot of information in here that we could just shove to the side. It's going to be irrelevant to us, mainly because it's going to be a broker trying to sell us. Remember, they represent the seller. They do not represent you. So one of the things we look at is, what is the offering itself? And then you start to get some information about the property. Any information about the property, we definitely want to take into consideration. Then there's investment highlights, and there's some information here about the Allen McKinney area. You can take that information at a high level, but you're going to want to go verify it yourself when you do your market analysis. But it's a good starting point with some of the market data that these brokers are providing to us. And I hate when they do these side by sides. I don't know why they started doing this. Cushman and Wakefield started this, and now these other brokerage firms are picking it up. And it's just ridiculous because you can't read the damn thing. So pictures are another good thing. You can kind of get an idea of what the property looks like now, and maybe have an idea of what you could do to it in the future. Here's some location information, which is good to know stuff. Some more things about North Dallas, which is the Allen area, which happens to be the practice facility for the Dallas Cowboys. More area information. So, this has got a lot of pie in the sky stuff about the market itself. And we've had very little about the property so far. They're trying to sell you on the market first to get you excited because Allen is one of the newest, most up and coming cities, primarily because of Dallas putting their practice facility in Allen, and it's kind of exploded from there and has become a real high-end area. So now we start getting into value add opportunity, right? So all of your OMs will have something like this. What the heck we got going on here? Okay. So what we see here is you can see what they're telling you they're getting for premiums, what their costs were, and their return on investment. You're going to have to do due diligence on that and verify it yourself. You may or may not be able to meet these numbers. It depends on your vendors. The seller may have better vendors that they use on multiple properties and get better prices. So you're going to have to verify these for yourself. Okay, property description. This is definitely information that we need, which goes all the way from where it's located, the investment summary, type of construction, parking, information about the schools, any fees for leasing, 2021 tax rates, which, if you know, in Texas is a really big stinking deal, other tax information, and then utilities. And we'll talk about tax information a little bit later. So more pictures. And then again, more about the market. So up to this point, we've gotten a decent idea of what we're looking at because we have factual information about the property, and we should have some factual information about the market. But now we're going to start getting into comps and financials. And I don't care who you are. Allen's up here, and we got North Dallas way the heck down here, Glenview area, Creek Trails. These are not going to be comps for Allen. I don't care who you are. It isn't going to happen. Okay. The comps are going to be in a trade area or neighborhood, if you will, but it's kind of an extended neighborhood that is the direct competition for this property. If you don't live in Allen, you are not looking at these assets to compete with. You want to live in Allen. So be careful when looking at the broker's rent comps. And I'm going to show you next Saturday how to pull rent comps. So from this point pretty much forward, it's all pie in the sky, and we really don't give a crap. We can look at it and say, okay, well, we can see what they think it's going to be. We can get a good laugh about it and then move on. And then we get into the investment summary. Oh, this is tough. In the investment summary, it goes right back to their investment. Ooh. Sorry about that. Ooh, that feels much better getting that out of there. Oh, wow. I feel a lot better after that got out. Sorry about that. I will try to cut that out of the recording prior to launching it on Monday. All right. So, and I know this is hard to see. Let me increase this up a little bit. I hate stupid brokers. So you can see again, a repeat of information they had about their value add premiums. And then if we scroll over here, you start to see what their, they had a February trailing 12, a February trailing 6, February trailing 3, and a trailing 1. Okay. Now, the trailing 6 means nothing to anybody, and the trailing 1 means nothing to anybody. They're just trying to make things look really stinking good. If you've got agency debt, you will need a trailing 3 because the agency lender will do a trailing 3 to determine the income from the property off the last 3 months, because they like 90 days of occupancy. That's why they do a trailing 3. But you want to look at this and make sure that only the income is on the trailing 3 and not the expenses. And we can look here and see that they did not include the expenses on the trailing 3. So at least they did a good job on that. Okay. But again, these are their numbers. We don't care about their numbers. We're going to pull the information off the T12 ourselves when we get there, and we're going to talk about the T12, and we're going to put that information in ourselves. Okay, 10-year cash flow analysis. Again, this is their 10-year cash flow, not yours. They have no idea what your discount rate is, and yes, we will talk about discount rate in a little bit. So this means nothing to you. And the unit mix summary is something you need to know, because this will give you the exact number of floor plans, how many are in each floor plan, the percentage, square foot, and then the rents. So here they're giving you market rent. Don't believe it. You're going to pull market rent yourself, and market rent per square foot. And then it gives you the monthly market rent. And so this is interesting. So they're not giving you the actuals. They're just giving you market rent. That's pretty cool, huh? Yeah, no, it's not. Why did they do that? Okay. Yeah, I have not seen one like that before. That's blowing me away that they did market rent and not actual. Normally they'll do market and actual, but here they didn't even put in the actual. They just put in market rent. But again, you're not going to believe their market rent. We're going to prove it when we go into the market and look at it. And then it just talks about their brokerage services and about them. All right. So that's the OM. So there's pieces of the OM we need, and there's pieces of the OM we want to push aside. Anything that is their numbers, we don't care. Anything that starts talking about assumptive anything, we don't care. And then any kind of forward-looking, we don't care. We're going to do our own forward-looking. We're going to do our own assumptions, and we're going to use the numbers that are currently in the financials that we're provided to make decisions. And I'll show you that as we go. All right, rent roll. That is the next thing we look at. This is a register of rents, including the names of tenants, units, lease rents, market rents, other income, amount due, lease start date, move-in date, lease expiration date, and balance due. That would be a really good rent roll. And I have two examples I want to show you. One that is like this one, which goes with the Presidio apartments, and one that you will typically get on smaller properties. It's okay. We can still make decisions off a napkin rent roll, if it's kind of what I like to call it. We just need a starting point. We're going to do due diligence, and at some point we're going to be able to see the leases. And at that point, we can create our own rent rolls. So don't get your panties in a bunch, if you will, if you end up getting a rent roll that looks like this. Because chances are this is the kind of rent roll you're going to get on a pretty consistent basis, especially on properties that are smaller and aren't really professionally managed. And I see this all the time, but you know what? This is okay. This is a starting point for me. For me, all I need is a rent roll. Give me a rent roll and I can do a whole valuation. I don't need a P&L. Just give me a rent roll. Okay. Here's what Presidio's rent roll looks like. Okay, a little different. Now we've got some more detail. So now we have the unit number, unit square foot, 854 square foot, the market rent that they say is market rent. Again, be careful with market rent. And it'll be interesting to see what they have for market rent average for this and what they have on the T12. And then the amount rent. So this is the lease amount, their deposit, their move-in date, their lease expiration date, and any balance that they owe. If the balance they owe is negative, that means they've overpaid. If the balance they owe is positive, it means they owe that much. Okay. So this was 170 something units, I think. What was this? 202 units. So we'll come all the way to the bottom. Here we have a summary. Okay. Total square footage. But what we're really looking for here is total non-revenue units. One, we have 193 occupied and 8 vacant. Now, in the chat, who can tell me what that one non-revenue unit more than likely is? Yeah, exactly, Cabern, model. So that would be their model. Now, on an older property, it wouldn't be the office, Richard, not on a big not on a big property like this. On smaller properties, yeah, it could be an office. It could be a down unit. Could be storage on smaller properties. But again, on a big property like this, it's going to be a model unit. So a lot of the codes up here, V trash, pest, UB trash, pet rent. You've got a bunch of different codes. We can then look here, and this gives what total amounts there are. Now, normally there's a diagram that explains what they are. This one doesn't. So obviously rent is rent. UB trash, and so V trash is going to be valet trash. I don't know what UB trash is. Pest is obviously pest. Pet rent is pretty, this is carport. Resins, don't know what that one is. Oh, insurance, resident insurance. Don't know what insurance they're charging here. And then I don't know what that one is. But you can kind of get an idea. Now, what you want to do is just ask the broker, what do these mean? Okay. So don't guess. Ask them what they mean. All right. So that's a good rent roll. The other one, terrible rent roll, but we can still work with it. From here, now when we get to the T12, which is next, you'll see that we can now verify, okay, this is, what month is this? Now, normally what they'll do is they'll give us a current rent roll. So this is March of 2022. And when we get to the T12, it only goes to February. So now what they've done is you cannot verify the rent roll to the T12. So what you want to do is you want to ask for February's, actually January's. You want to ask for January's rent roll. That way you can verify that the rent roll matches the income on the T12. All right, so that's the rent roll. T12, trailing 12-month profit and loss statement. This is a financial statement that shows a multifamily property's previous 12 months of operations monthly from the potential rental income all the way to the cash flow before tax, and can be displayed on a cash or accrual basis. So let's go back and look at Presidio's T12. So we can see here that they say it is accrual. So when it is accrual, it means that we have potential rental income. Okay, that is the big deal here. And the reason this is the big deal is because potential rental income is what they consider market rent. Now, there are two ways to look at market rent. You can look at market rent as market rent in the market itself, and there's no rhyme or reason as to who does this and who doesn't. Or you can look at all your leases and you can say, for a given floor plan, what is my highest lease amount for that floor plan? And that becomes the market rent. Again, it's about 50-50 across the board as to who does what. So you just have to determine, ask the broker, what does their market rent, what is their gross potential rent? Is that the highest lease amount on the leases, or is it the market rent in the market? If they have gross potential rent, they need to have gain or loss to lease. Okay. And we're going to go over all this as we go through the definitions and acronyms. So just know that on the T12, you have the trailing 12 months. This is all your income. And we're going to go over all this in a minute. All your other income. I don't know why they put the utility income separate, but that's okay. And then you start your expenses, and your expenses go all the way down to the net operating income. Now, this T12 does not go below the net operating income. A lot of T12s will, where it'll show asset management fees, it'll show capital expenses, the debt service, all that information. It'll show it and get you to cash flow before tax. This one did not. You don't need to know any of that information, which is why Marcus and Millichap decided we don't need it. Okay, we'll be going through this T12 pretty extensively as we get through acronyms and definitions, because a lot of the acronyms and definitions will follow the APOD, which is, go back to this, the APOD is potential rental income all the way down to NOI and including all the way down to cash flow before tax. So we'll look at each one of these as we go down that. Profit and loss statement. A lot of properties, especially smaller ones, Richard, APOD is annual property operating data. It's just a acronym that financial analysts in the academia world created to give a name to a P&L. Profit and loss statement. This will be something you'll get from smaller properties. If you ask an owner for a T12, he may look at you cross-eyed. If it's a 20-unit property in, I don't know, Monroe, Alabama, they'll probably look at you cross-eyed and what the heck's a T12? Do you have a P&L? Oh, yeah, I know what a P&L is. Yeah, I can give you a P&L. Okay, so when you get a P&L, it is not going to be a trailing 12 P&L. You can get a P&L because they're going to get it from their CPA. Typically, if they are running like QuickBooks, they can pull a P&L from their QuickBooks. But it's typically going to be an annual profit and loss, so calendar, January through December, and then you can get a year to date. So if you're in the middle of a year, you're going to want both. You're going to want an annual from the previous year, and you're going to want a year to date. Okay. So this is a financial statement that shows a multifamily property's previous 12 months of operations annually or year to date from the potential rental income all the way to cash flow before tax, and can be displayed on a cash or accrual basis. So let's look at what a P&L looks like. So here is a fairly decent P&L. They say it's on accrual basis, but technically it's not, because it does not have gain or loss to lease on it. And you're going to see some things on this one that you need to look out for when you're looking at these kind of statements. So looking at this right now, who can tell me what stands out to you that should not be in operating expenses? Put it in the chat. What do you guys see on this statement that should not be there? Yeah, interest. Exactly. What else? What's the other one? No. Yeah, depreciation. Exactly. Okay, so depreciation and interest, loan interest, both of those belonged below the line. As a matter of fact, depreciation doesn't belong on the P&L at all because that is an after-tax calculation. So that does not belong anywhere near operating expenses. All right, so it's a decent P&L because it's got everything. But again, you've got to pay attention to what's in it because you may have to extract some stuff out. Now, why they'd want to put that in there because it lowers the NOI is beyond me. But it's what they did. All right. So that is a P&L. You will see this on properties that are, again, smaller. Now, I have created, and you will need 12. Yeah, you will need you'll need them to pull a P&L for 12 months if they're willing to do it. Some won't be willing to do it, but if you want to create your own T12, I've created a T12 template for you. Okay, and this will be in the resources when you guys get the recording on Monday, if I'm feeling better. It may be a little delayed. You're gonna have to bear with me. All right. So that's profit and loss statement. Again, we just need enough information that we can pull, that we can add to our model to make decisions. The numbers from the owner are the numbers from the owner. Those are just facts. Where we start to get into our forward-looking data, those are our assumptions. That's what we're going to work on next week when we go into our supply side and demand side data tools and we start to pull those assumptions. Those assumptions are what's going to make or break your model, not these numbers. These are just facts. So don't overstress if you don't get a good T12. The last one's an owner statement. This is a financial statement that shows the multifamily property's previous single month of operations and only shows the income and expenses from that month and is sent to the owner as required by a management agreement. These are typically on smaller properties and have a residential, like single family residential property management company managing them. These are the owner statements you would get if you owned a single family home and rent it out that you get from that management company. I don't have an example of one of these. I used to, I couldn't find it. I looked for it. I couldn't find it. But if you can ask for the last 12 owner statements so that you can create your T12. Now, just remember that it is literally just the income and expenses for that month. So it won't have all the line items. You know, your T12 will have all the line items, but the owner statement will only have the line items that income was received from and that expenses were paid to. Okay. Next is our APOD, our annual property operating data. Okay. So those are the three things or four things, three things. We need an OM, we need a rent roll, and we need a T12 P&L or list of owner statements in order to start making decisions for ourselves. If it's an owner, you got direct to owner, there's not going to be an OM. Don't ask the owner for an OM. The owner's going to look at you cross-eyed and say, son, maybe you're not ready for this kind of business yet. So don't ask the owner for an OM. That is from a broker. All right. So you just need, and honestly, when you get good at this, you're only going to need a rent roll. But we like to have this other stuff anyway. All right. So that's what we need. Now let's get into the APOD. So it's really the T12, the P&L, the owner statement. What is on it? So we start with the potential rental income. This is the total amount of rental income for a property if it were 100% leased at competitive market rates. And again, it could be the highest rent for that floor plan for that market, or it could be for the market itself. Okay. And if I said highest floor plan for the market, I apologize. I meant for the property. My mind's playing tricks on me. So I think you get my point. It's either going to be the highest lease amount for the property or the market rent for the market. Now it gets a little foggy when you try to do it for the market because not everybody draws a market the same. It's more accurate if you do it for the highest rents on the property. Okay. But this is their T12, not yours. How they did it's how they did it. How you do it's how you're going to do it moving forward. All right. We just need to know which it is so that we can make informed decisions from it. So if we go back to the T12, we can see here they call it gross potential rental income. That is not what it's called. It's called potential rental income, but that's okay. They're just brokers. They don't understand. Okay. So this is what they say the market. I love how they're growing it as it goes up, but again, it could have gone up because of rent bumps. So in total, you had 2,942,463. Okay. That's potential rental income. If the property is 100% leased at that market rent, this is what the total would be. Okay. If you have potential rental income, you must have lost a lease. If you do not use potential rental income and you only start with your actual rents received, then you will not have lost a lease. So lost a lease is the difference between a unit's market rental rate and the actual rent per the lease. So if we go back, whoops, wrong one. Sorry about that. Here is the gain or loss to lease. Okay, so not too bad on a 202 unit property. You only had a loss of lease of $9,400, 11,000, which, okay. See, this is why I hate brokers. God bless America. Do you guys see this? We have all these loss to leases that range, 93, 89, 91, 80, 47, 35, 112, 1841, and we get here 11,593. Well, obviously they bump the rents up, market rents, because they're getting ready to sell the property. You just have to be smart enough to catch this stuff. Okay. But again, these are pie in the sky numbers. These aren't the actual lease rents. Okay. So just pay attention to that. This should be the actual amount if it was 100% occupied, all leased up. Okay. These are the leased rents at 100% occupancy. So that's loss to lease. Next is vacancy and credit loss. The amount of money or the percentage of potential rental income that is not realized due to vacant units and non-payment of rents. So back to the T12. Here you can see we've got vacancy, loss from model, and for whatever reason they have income in there, which they should not have. Okay. So garage rent, carpet rent, and pet rent all belong down in other income. They do not belong here. This is only leased rents, just the rent itself for the apartment. Okay. Not other income. So less concession, less vacancy, less from model. So it is okay to take out the amount for that model unit. Remember the one in the rent roll? If we go back to the rent roll, we go all the way to the bottom. We had that 1 unit. Okay. Now here they're saying it's 1515, but on the T12, well, let's see what the last month says. $1,301 all the way across. So even though they're telling you on the rent roll, it's 1515, they're only taking out 1,300 on the loss from the model, which is a $200+ difference, which makes the property more valuable. Imagine that. Pay attention. There might be a quiz later. Okay. You can catch little things like this. All right. And again, these belong down here. Write off of bad debt. Okay. That can also go up here to loss of lease because, or not loss of lease, that can also go to vacancy and credit loss because that is a credit loss. Okay. So this belongs up here. These three belong down here, and you'll see when we get there. All right. So vacancy and credit loss will get you to your gross rental income or effective rental income. I've heard it said both ways. Doesn't really matter how you say it. This is the potential rental income less loss of lease, vacancy, and all credit loss. Okay. And back to the T12. That's this number right here. Now they call it net rental income, but it's called gross rental income or effective rental income. Next is economic occupancy. So that is the percentage of gross rental income that a property achieves during a given period. I'm sure you've heard this term. So if we take the 215, or really take your annual number, take the 2,800,947, divide it by 2,925,165, and that is your economic occupancy as a percentage. So if we grab the handy dandy calculator, went up in my other screen. So 2,800,947 divided by 2,925,165. This property has a 95.25% economic occupancy. So they say, but it is a T12. That should be fairly accurate. Okay. Should not be any reason why this is a lie. And where this is located in this type of property, that doesn't surprise me, especially at these rental rates. They look pretty decent for this area. Okay. Can we see a T12 with line items all in the proper place or order? No, not today, Carlos. There's not enough time. I'm sure you see T12s all the time. At 3 o'clock this afternoon or 4 o'clock East, Charles Seaman will be doing his underwriting class. You guys can go to that, where he takes all the information and throws it in from a T12 to the syndicated deal analyzer. He may have something he can show you. Should you take out the garage rents, etc.? That makes occupancy seem higher. Yeah, you would. You would take these three out, bring them down here, and then you would do that again. And actually, that's exactly right. It gave you a different number. It gave you a better number. So your economic occupancy would actually be lower if you take those out. So again, little sneaky stuff brokers do. So good catch. That's right, Victor. You would do that. All right. Then we have other income, the amount received not related to the rent. Okay. Back to the T12. So that is all of this. That is all other income. Okay. All your utility income. So a lot of properties will bill back utility income. month-to-month rent fees, relet fee, unauthorized pet charges, former resident collections, all this other income. Okay. Now, where I want you to be careful with this is there are things here in this other income that you're not going to be able to charge for in the future. Maybe, depends on your management company. The only thing I want you to be careful of when doing this, when I underwrite a deal, there's a few things I'll put in other income. If I'm billing back utilities, I'll put it in. Garage rent, pet rent, carpet rent, I'm putting it in. These are things that are consistent month after month. A lot of this other stuff, application fees, unauthorized pet charges, damage, non-sufficient fund, late fee, convenience fee, all this stuff, I don't put any of that in. Because I do not want other income to be the decision on why I made or did not do this property. Okay. There are people that will make or break their deal on other income, and you're setting yourself up for failure if you do that. Do not do that. All right. Again, if it's utility income, trash, pest, garage rent, carport, pet rent, things like that, yeah, that's consistent all the way across. The other thing, Victor, is if we'd have taken the loss to lease or the bad debt and brought it up where it should have been, it would have made it even worse. So don't have time to go through all that, but yeah, it probably would have put it around 7 or 8%, which would have been about pretty accurate. Okay, so that's other income. That gets us to our gross operating income. This is the gross rental income plus other income. Pretty simple. So that gets us to, they call it total revenue. That's fine. Or total, after total other income, they have total GPA, net rental income, total utility income, and all these added together get you to your total revenue. Now, total revenue is what it is, no matter where it sits anywhere in here. Okay. So don't get too hyped up over where something is or not. It just depends on how you're looking at something else. So the total revenue, when we do operating expense ratio, it's total revenue divided by, or total operating expenses right there divided by, in this case, total revenue, but it's gross operating income. Okay. That's what it should be called. But again, brokers call it different things. Okay. So that's the income side. So recapping the income real quick for the APOD, potential rental income minus loss to lease gets us to our leased rental income, minus vacancy and credit loss gets us to gross rental income, plus other income gets us to gross operating income. Okay, that's where we are in the APOD right now. Now we're going to go to expenses. Operating expenses, the expenses incurred by a property during a specific period and includes all the items that it would take to operate the property and excludes all the items such as principal and interest payments, asset management fees, capital expenses, and depreciation. Okay. Basically, what you want to do is you want to look at the property and say, does the property need a loan to operate? Well, the answer obviously is no. You can pay all cash for a property. Does a property need an asset management fee to operate? No. To operate just fine without an asset management fee. Can it operate without a property management fee? No. It needs a property management fee because somebody's got to manage that stinking thing. Okay. So that would be an operating expense versus asset management fee would not be an operating expense. Okay. Capital expenses are items that get depreciated. Depreciation is not included in operating expenses. So if you replace a water heater, that is a capital item. That is a depreciable item. That should go into capital expenses and not on your operating expenses. But you will see that owners during operations will put their water heater replacement in operating expenses in order to lower the tax bill at the end of the year. That's all fine and dandy as long as you don't get caught. Yeah, there's that. Just don't get caught. So on the T12, come on, computer. The operating expenses start here and go all the way to the bottom. Right there. Okay. And it includes things like payroll, general and administrative, marketing, repairs and maintenance, utilities, management fees, taxes, and insurance. Okay. Property taxes. Now, if you have a company car, for whatever reason, the property is so large that you have a car that they drive around in, and that car is part of the property, then the tax for that car each year could be an operating expense. Okay, that license fee for that car each year would be an operating expense. Or like a golf cart, a lot of properties have golf carts. Okay, those are your operating expenses. Now, if you replace the golf cart, then it becomes a capital expense. Okay. Net operating income. This is the gross operating income minus the operating expenses. That is the next line on the T12. So after all the operating expenses, we get total expenses. If we take total income, gross operating income, and subtract all the operating expenses from gross operating income, we get the net operating income. The net operating income is what we use to value an asset. Actual net operating income, not future, actual. Just thought I'd say that. Annual debt service, continuing below the line. Now we can't go back to the T12 because this T12 does not have it on it. But starting after the NOI, now you start subtracting for things like annual debt service. This is the principal and interest payment paid on an annual basis by the owner to the lender. And this could be to multiple lenders depending on what they have. If they've got, if they assumed a Fannie Freddie and they were able to get one or two supplements, all three of those or two of three of those will all be included below the net operating income. Below that is debt service cover. Well, in line with annual debt service is debt service coverage ratio. Debt service coverage ratio is a result of dividing the net operating income by the annual debt service and is displayed as a decimal. Now, the lender is going to give you the lower of debt service coverage ratio or loan to value, which is the result of dividing the maximum loan amount by the purchase price. Now notice debt service coverage ratio did not say maximum loan amount. No, sir, it did not. So what the lender does is you hand the lender your underwriting, say, whoop, here you go, and you give them all the documents associated with it on what you did for your underwriting, and they come back and they tell you we're only going to give you a 55% LTV. Trust me, it is not because of where we are in the market and risk and all this other stuff. It's because your year one debt service coverage ratio did not meet the minimum. Okay. They have a minimum. That minimum is either anywhere from 1.2 to 1.4. I don't think I've ever seen it above 1.4, and I've only seen it below 1.2 once, and that was Blackstone that got one for 1.15, which, if you didn't catch the news, Blackstone is struggling. Pay attention to what's going on. So what does this mean? 1.25. So 1.25 means that your NOI should be 25% greater than your loan amount. That's what they're looking for. They want to make sure that there's cushion so that if something happens in the market, you have enough cushion where if you get down to break even occupancy, that you could still pay your debt. All right. That's why they do the DSCR. But the lender is going to give you the minimum of the two. You're either going to get loan to value, which we're hoping for 75% in most cases, maybe 70, maybe 80. 80 is probably a little aggressive, especially today. 70 is pretty normal. If you can get 70% LTV, it means that your debt service coverage ratio was good per the lender and your numbers are good because you did good assumptions and you didn't listen to the broker and you did a market analysis first, which again, we're going to do next week. Any questions on that? This is really important, guys. You really need to understand this because so many of these damn syndicators in the market right now that are buying these 100, 200, 300 unit properties are complaining because they can't get 55% LTV and they don't, because they can't get 75% LTV and they don't know why. And they're being told, oh, it's risk in the market. No, it's not. It's because their debt service coverage ratio doesn't meet the minimum in year one. There is no other reason. Everybody good on that? Okie dokie. Interest only period. This is a product offered by lenders where you only pay interest on a monthly basis. And when the loan is due or the amortization period starts, the original loan balance is still the same. So if you start with $1 million and you get an interest only period of 3 years, at the end of that 3 years, your loan balance is still $1 million. So you are only paying interest. You're not paying any principal. And when in 3 years, when that interest only period stops, then your amortization period starts. And now you need to make sure that your debt service coverage ratio does not go below that minimum required by the lender, because there's a clause in the loan documents that says if your property drops below the minimum debt service coverage ratio, the lender can call the loan due. You don't want that to happen. Now, under a normal circumstance, I don't think they do that. I think they give you the opportunity to get it back up. They'd probably even help you a little bit. But these aren't normal circumstances. So just pay attention. There might be a quiz later. Below the line expenses. Okay, these are all the expenses below that NOI line that we've just been talking about. Okay, the expenses occurred on a property such as capital improvements, asset management fee, and your debt service. That gets us to our cash flow before tax. So this is the result of the net operating income minus annual debt service minus all the below the line expenses, and that gets us to cash flow before tax. So here is a diagram of what we just saw. We start with potential rental income on that T12 minus vacancy and credit loss gets us effective rental income or gross rental income. Plus other income gets us gross operating income minus operating expenses equals net operating income minus annual debt service and other below the line expenses gets us to cash flow before tax. That, my friends, is the APOD. Did that help? We still got a lot more to go. That was the whole meat of this presentation today. Understanding the APOD, understanding the T12, because those two things are going to help you more than anything else in underwriting. All right, you guys ready to start talking about the heavy stuff? We haven't even talked about the heavy stuff yet. Heavy stuff's about to come. Those definitions that are going to whoop, 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 right over our heads. I guess you can call it the stack, Carlos. Never heard it called the stack. Typically, I'm a marketing guy, so when I hear the stack, I'm thinking offer stack. But interesting, that could be called a stack. I actually kind of like that. All right, so let's talk about KPIs. Key performance indicators. First one we're going to talk about is a test. This is a check and balance. Since we just finished the APOD, and I mentioned this when we talked about the APOD, is the operating expense ratio. This is the result from dividing total operating expenses by the gross operating income and displayed as a percentage. Let's go back to that T12. So if we come down here, total operating expenses, that's total expenses. Let's bring up our handy dandy calculator again. 110. Oh, let's go to annual over here. Let's go to the annual number. 1418 177. I round up, or actually I just put the actual numbers. Those cents aren't going to matter at these numbers. And then our gross operating income, which is in this case total revenue, is 3006. Whoa. Divided by 3006. 507. Now I want you guys to pay attention to something. We're going to do year one or month one. This is month 12, or this is total. But we're going to go back and do month one and see how big of a discrepancy this is. So okay, it's not bad. Never mind. It actually ended up better than I thought. So this says 47% operating expense ratio. This is on a fairly new property being operated by a very efficient management company. I like that number, 47%. Okay. That's a good number. That's a number I can live with. That means that 47% of the total net of this property is operating expenses. That's what that says. You are going to see pro formas put in front of you from other syndicators and other investors that are going to have 30%, 33%, 32%, 35% on properties built in the 70s, 50s, 40s, 30s. Don't believe it, folks. It ain't happening. This property is damn near brand new, and it's operating at 47%. Okay? Pay attention. There might be a quiz later. All right. Next is cap rate. This is the result of dividing the net operating income by the current value and displayed as a percentage. Now, I want to say they were asking 41 million for this. I don't remember what the number was. That was the whisper price, if I remember right. So let's go to NOI. And we'll just say it was. So we're going to clear this. NOI is this bottom number, 1,588,330 divided by 4,1,1,2,3,4,5. There we go. Equals, that's a nice 3.9 cap. And we haven't even normalized for expenses yet. Okay. So what the agency lender is going to let you do, if you got an agency lender, they're going to let you do a T3. So you would take these three for income. You could take these, and that will give you a new total income. You would just take these three and multiply them, average these three, multiply it over a 12-month period. That's what it's known as a T3, but you don't get that on the expenses. Expenses stay the same. You're also going to have to adjust your property taxes because your taxes are going to go up. And you're also going to have to adjust for your insurance because your insurance more likely is going to have to go up. And then any other thing you see on here that does not belong or is missing that you would catch. On a big property like this, probably the rest is going to be good. But without even normalizing, we're already at a 3-point-something cap rate. I mean, just insane, stupid numbers. And this was May, June, July, something like that when this was offered. Just crazy numbers. So that's cap rate. So here's what we call in the CCIM world the IRV formula, IRV. I equals income, R equals rate or cap rate, and V is value or price. So if you have two, you can get the third. So if I want to know what the NOI is, and I know what the asking price is, and I know what the cap rate is, then I know what the income should be because I can just go value times cap rate will give me what the NOI should be. If I want to know what the cap rate's going to be, then I can take the value, divide it by the NOI, and that will give me the cap rate. If I want to know what the value is, then I can take the cap rate divided by the NOI, and that will give me the value. Okay. No two, you can get the third. This is called the IRV formula. All right. So now the hard stuff. Discount rate. A couple of you have heard me use this term before. Well, I talked about it in the masterclass. How many people? Oh, only 10. Man, that's disappointing. Only 10 people came in. All pretty much new people too. Good Lord. So, discount rate. The interest rate used to discount a stream of cash flows to their present value. When the discount rate and IRR are equal, the net present value is 0. Now, discount rate, IRR, net present value, and yield are all synonymous with each other. They're just used in different contexts. And we're going to go over this. Okay. So basically, our discount rate is our risk. What rate of return? If I've got 100 grand in my pocket and I'm going to whoop out 100 grand and I'm going to hand it to you to invest it, I want a rate of return for that 100 grand. That's my discount rate. That's my risk. If I'm going to give you $100,000 to invest, I want a return. That return becomes my risk. Okay. So let's say it's 15%. So when you do a pro forma and the internal rate of return on that pro forma is a 12% internal rate of return, and your discount rate is 15%, that means that your net present value is going to be negative. However much negative it is means that's how much less you have to pay for the property in order to get your 15% internal rate of return. If, on the other hand, your internal rate of return after your pro forma was 18% and you have a 15% discount rate, then your net present value is going to be positive, which means you can pay that much more money for the property and still get your 15% internal rate of return. Does that make sense to you guys? I'm the only one you're going to hear talk about this. And I think primarily because the gurus out there have no idea how this works. I see no questions. So I am going to move on. The next part of this is internal rate of return, which is very misunderstood. Okay. All right, Susan. So if you're buying a property for $1 million and you have a discount rate of 10%, and that means you want an internal rate of return of 10%. If you do a pro forma, 5-year, 7-year, 8-year, we're not going to talk about XIR. Josh, don't start confusing people. Leave it alone. Go away. Don't go away mad, just go away. MIR and XIRR are way too advanced for everybody in this class, except obviously for you. We are not going to go into MIR and XIR. I would just be happy with people using discount rate and net present value and internal rate of return correctly, let alone XIR. What XIRR does, guys, is it allows you to adjust on a monthly basis. You don't need to know that, okay? That not for right now. That is way advanced. We don't need to know that. So, Susan, you're buying a property for $1 million. You have a 10% discount rate, okay? That means you need to achieve a 10% IRR to be happy. You run your pro forma and you end up with an 8% IRR. That means that your discount rate is higher than the internal rate of return. Remember, when internal rate of return and discount rate are the same, net present value is 0. If the internal rate of return is lower, it's negative. If the internal rate of return is higher, it is positive. Since it is lower, let's say it's lower by 200,000, and I don't know what that number is, the math in my head, I can't do math that easily, but it would be somewhere around $200,000. That means in order for you to get that 10% internal rate of return based on the cash flows you've projected, then you can only pay $800,000 for this property. The net present value tells you what your strike price is for you to get your discount rate, your target internal rate of return. Does that make sense? All right, I'm gonna move on. So internal rate of return is the rate of return each dollar in an investment earns while it is in the investment. If I receive a cash flow at the end of the year, is that cash flow still in the investment? Put it in the chat, yes or no. Carlos says no. Muriel says yes. Richard says no. No, it's not in the investment anymore. We've removed it. It's out of the investment. So if I invest $100,000 and I get $8,000 at the end of year one, and that was a return on my money, not of my money, that means I still have $100,000 that is still in the investment. That's what the internal rate of return is tracking. It doesn't care what your cash flows are. It only cares about how much money was invested, when was it invested, when does that money come out, and how much comes out. That's all it cares while it's in the investment. So if I'm on a 5-year hold and that 100,000 stays in that investment through the whole 5 years, and then I get it back at the end in my reversion, which is the sale of the property, as well as my return, that's what internal rate of return cares about. Okay. It only tracks the internal rate of return, the money that is still left in the investment. Once money goes out, it stays out, can't come back. Okay. I know that sounds confusing. It's why we have financial calculators, but just understand that your cash flows every year don't have anything to do with your internal rate of return. It's how much money do you put in? When does it go in? How much money do you get out? And when does it come out? That's the money you put in. When do you get it back? And then how much? Okay. How much did I put in? When did it go in? How much do I get out? When did it come out? Well, that ending one, when it comes out at the end, is the one that matters. That all those cash flows will go on your cash on cash returns, which we'll get to in a minute. Net present value is all it is, difference between value and cost. That's it. That's all net present value is. That's why when IRR and discount rate are the same, net present value is 0. That means that I am valuing this property the same as its cost. We're equal. When IRR is lower, that means my value is lower than the cost. When net present value is higher, that means my value is higher than cost. Okay, that's all it means. Of course, there are calculations to figure this out. Those calculations go beyond the scope of this lesson. Cash on cash return. The result of dividing the cash flow before tax and the total amount of equity invested in the property. Okay, this one's pretty simple. If I invest 100,000 and I get 8,000 at the end of the year, that's an 8% cash on cash return. Pretty simple number. Okay, that's all that is. Equity multiple. This is a metric that calculates the expected or achieved total return on an initial investment. It's calculated through an equity multiple formula that divides the total dollars received by the total dollars invested. So it's basically just all the distributions divided by total invested. That's distributions from year one all the way to the money you receive from the sale of the property. That's all distributions. Divide that by total invested. That's your equity multiple. Cameron, to clarify, the IRR does not take income received from cash flow into account on the return, correct? That's correct. That is correct. Okay, one clarification there though. It will take it into consideration if it does not come out. So if that income received does not come out as a distribution, yes, it takes it into consideration, because now my 100,000 went to 106,000 because I didn't get my preferred return. Does that make sense? Because it's money left in the investment. Yeah, it's compounding. That's right. Good. Average annual return. Now, this one, I think syndicators made this one up, because if you go to college and you take a finance course, this doesn't exist. At CCIM, who writes the curriculum for 135 universities across the country for their real estate MBA programs, this calculation doesn't exist. But it sure the hell exists in the multifamily syndication world, so I threw it in here because it is a metric that everybody is using to snow their investors. And yes, that's the only reason you could be using this, is to try to make the cash on cash return look greater than it is. It is the average of all the cash on cash returns during the holding period, including the sale of the property. Okay. That's not how you should, that is not transparency to your investors. And look, I'm telling you, if the SEC starts investigating and this is how you touted your cash on cash return, you're going to be in a lot of trouble. Do you have a sheet with all these? You're going to get copies of these slides, Richard. Break-even occupancy. This is the sum of all operating expenses and debt service divided by the total potential rental income. So all my operating expenses plus debt service divided by that very top number on the T12, the potential rental income. That's my break-even occupancy. That means that this property can operate at this level and still be able to make the debt. That's 1.0 debt service coverage ratio, not 1.2, not 1.25, 1.3, whatever the lender requires. That's 1.0. That is break-even occupancy. Sum of all my expenses plus debt service divided by total potential rental income. That very top number. Okay, here's the calculation. Pretty simple. Preferred return, this is the claim on profits given to preferred investors in a project, also known as a pref. You know, these days, who knows? We've seen as little as 6%, as high as 12%. I think I saw one recently, it was 20%. You can't even get a 6%, and you're going to promise your investors 20. Woo, aren't you nice? It's really been, yeah, I don't want to get into it. I'm not going to talk about it. It's been a weird couple of years for the multifamily investing world. And it's been a, how do I put it? Let's just say they've been greedy. Let's just put it that way. They have not been treating their investors properly. Okay. That's all I got to say about that. So just know preferred return, claim on profits given to preferred investors in a project, also known as a pref. So if, again, let's say it's 8% and they invest 100,000, then that means at the end of year one, they're due $8,000. They get the first 8,000, period. Okay. You don't get to touch any of the money until the investors get theirs first on a pref, period. If they don't get it, and it better be a cumulative, then that whatever they didn't get gets tacked on to next year. So if you don't pay them anything in year one, now you owe them 16% in year two. Ooh, isn't that nice? Now, there are some that will defer the delayed payments until the end and do a catch up at the end. Again, I think that's wrong, but it's in the PPM and it's what they do. It's all about greed. Hurdle rate, the minimum rate of return on a project or investment required by a manager or investor before they can participate in the returns described in the PPM. So hurdle rate is a second level. So if I've got a preferred return of 8 during operations, after 8%, as a sponsor, I can participate, meaning I'm now splitting at whatever that rate was. Let's just say it was 70, 37 to the investors, 30 to the sponsor. So the sponsor can start participating 70-30 after the first 8%. There can be a hurdle of, let's say, 12%. And if that 12% is met, and this is typically done at the end when you sell the property, because rare are you going to see cash on cash is this high. But if you can get to 12%, then a hurdle has been met. And so now instead of 70-30, we're splitting 60-40. And you can even have another hurdle at, say, 15%. And if that gets met, now from that point forward, we're splitting 50-50. So from 0 to 8, the investors get all the money. From 8% to 12%, we're splitting 70-30, 70 to the investors, 30 to the sponsor. From 12 to 15 or 13 to 15, it's 60 to the investors, 40 to the sponsor, and anything after 15 is 50-50. That's how a hurdle rate works. And you will see those, and those are fine. I have no problem with those whatsoever. Okay. That is it for the definitions and acronyms. So now let's start getting into some fees and costs. Coming to the end, folks. So costs, we have capital expenses. Remember, we've got capital expenses, we've got operating expenses. Okay. Operating expenses are repairs or utilities or admin or payroll or landscape, management fee. These are all things. Operating expenses are during operations. These fees and costs are below the line. Okay. So capital expense is replacement of a roof, replacement of a hot water heater, replacement of kitchen cabinets. That's an upgrade. That is considered a capital expense. IRS says replacement of carpet or flooring, that's normal wear and tear. They look at that as an operating expense. Same with wall paint. They look at that as an operating expense. Everything else, you replace it, that is a capital expense. Closing costs. Okay. You've got your title company, your attorney. I'm going to cover appraisals and things like that in a minute. You've also got the title fee. You're going to have a bunch of lender fees, which I'll show in a minute. But the closing costs, and either can be divided or one person will pay. In this competitive environment, buyers been paying for everything. It's been stupid, but it's shifting back now. So it's going to start evening back out again, where it'll be 50-50 on closing costs. Vendor costs, these are things like your appraisal, your engineering reports, property condition assessment, and environmental reports. Anything needed to do your due diligence and appraisal. We could have put the appraisal in the loan costs, but it is a separate cost, and that is something you have to pay sometimes up front. Sometimes they'll let you pay it at closing, but it gets paid whether the property closes or not. Same with the engineering reports, the property condition assessment, environmental reports, so on and so forth. The loan costs can be pretty extensive. Depending on the kind of loan you get, you can end up with an agency loan. And the thing that's going to cost you the most on an agency loan really is going to be your defeasance, the prepayment penalties if you try to get it out of it early. But there's ways even around that. But you're going to have, if you have a mortgage broker, you're going to have that mortgage broker fee. Then you're going to have loan application fees, attorney fees, doc fees, these fees, those fees. Just so many doggone fees. It's crazy. The lender's got a lot of fees, so pay attention to all the fees associated with the lender costs. It can typically go up to 2% of the total amount of the property. It's pretty crazy, the costs that have been associated with it, especially if you start getting in. If you're buying an adjustable rate mortgage, which would be absolutely stupid today, but people are still doing it. You get a rate cap. That rate cap's costing anywhere from $500,000 to $1 million. So let's talk about some fees we can get instead of pay. So you can get an acquisition fee. Now, this is strategic partnering. And I talk about go find an opportunity and don't limit yourself to just smaller properties. seek out larger properties. You know you can't close a larger property, or maybe you can. Maybe you have the relationships to do it, but if you can't, still seek out those properties, because you may be able to take a 200 or 300 unit property and find someone in the community or other relationships you built that can take that down, and you hand that off to them for an acquisition fee. Okay, that's what strategic partnering is all about. What you can't do if you're not a real estate agent or broker is you cannot negotiate between the buyer and seller. And you better get a fee agreement before giving that syndicate, even if he's your best friend, get a fee agreement signed first before you ever hand off even the state it's located in. These days, people are pretty smart, can find stuff pretty quick. Co-sponsor fee. So if you are a co-sponsor, you've got a primary sponsor that's looking for co-sponsors, you can get a fee for coming in as a co-sponsor, maybe get part of that acquisition fee, get a piece of the GP as a percentage, different things like that. Asset management fee, if you're a primary sponsor and or on the asset management team. Not everybody is entitled to the asset management fee. Not everybody is entitled to the acquisition fee. Loan guarantee fee, these are the KPs, the key principals. They come in and they'll either ask for a percentage of the deal, or they'll just ask for a loan guarantee fee, or sometimes both. It's all negotiable. Refinance fee. So if you have a 3-year interest only, and then you're going to refinance it and then continue to move on, it takes effort and energy to go find a lender that will do that refinance for you, so you're entitled to a fee for that. Exit fee, be careful with this one. Remember, you got to pay a broker. Don't get crazy. You don't want to steal from your investors. The only thing you have to do is hire a broker, and that's really easy to do. Now, if you're trying to sell this deal yourself and not use a broker, first of all, shoot yourself in the forehead. You want to use a broker when selling. Secondly, then you would be entitled to an exit fee, but it isn't worth it, because you're going to get more letting the broker sell it, even if you didn't take the exit fee. All right. So just keep that in mind. All right. Homework. Memorize the acronyms and definitions. Yes, I know that's a lot. Maybe I'm a little flippant on that one, but it would be nice if you would memorize all the acronyms and definitions. Download the APOD worksheet and become its master.